Good morning, everybody. Thank you very much for joining us. There we go. Perfect. So today we start the very first Sustainable Finance Summit for the Central and Eastern European region. It is co-organized by 12 civil society organizations across the region, based in very wide range of countries. We have Romania, Bulgaria, Czech Republic, Slovakia, Hungary, and Poland. We will hear from speakers from all across Europe. We're very excited to be able to put up this summit because it took us quite a while to figure out who actually works on sustainable finance in the region. Turns out it's a relatively new topic in this particular part of Europe, even though Europe now has decided to try and go carbon neutral by 2050. We are facing many challenges. And to decarbonize, we will have to make big changes to our livelihoods. I think our start has been slow, but we can see a lot of progress in how people are thinking about this, how they're trying to avoid a new green iron curtain in Europe. That was the idea for the very first Sustainable Finance Summit, to show that these 12 organizations that are helping us to co-host this event are actually making big changes. They're trying to figure out how we're going to finance decarbonization, how we're going to look after our people while also cutting emissions, because there is no business on a dead planet, as Sharon Burrow once said. And it is very exciting to see that different organizations can come together, that we can work together, and that we can co-host a summit that has over 75 speakers, looking at a wide range of different topics, from EU ETS to carbon adjustment mechanisms, to capital markets, to sustainable investing. So it's going to be a week that will be filled with very exciting events, with a lot of different speakers, a lot of different perspectives. So please make sure that you tune in every day, whenever you can. We will have 3 sessions, one in the morning, every morning at 9 a.m., one at lunchtime at 12 p.m., and one in the afternoon at 4 p.m. You can find the entire program on the event website. You will also see all the speakers, and you'll find all the links to register to each of the sessions, and you'll get a reminder on the day when to join. So without much further remarks from me, I'm actually currently sitting in Florence and joining you from the School of Transnational Governance at the European University Institute, where I'm a policy leader fellow. And I'm also the CEO of International Sustainable Finance Center. That was one of the lead organizations that put this summit together. And today with us, we have a special guest who's going to do a few minutes of introductory remarks. With us, we have Professor Alexander Stubb, who is the director of the School for Transnational Governance at the EUI. He was the former Prime Minister of Finland. He is also a thought leader and has written quite a lot about Europe. He formerly was also a minister, foreign minister, finance minister. He has been in politics for a while. But also the fantastic thing is that Alexander Stubb also is an academic. So it's a very exciting mix of experiences, and we're very happy and honored to have him with us today. So without further ado, please, Alex, the floor is yours.
Thanks a lot, Linda, and good morning to all of you. I'm actually sitting in my flat here in Florence, and I'll be up there in the hills of Fiesole a little bit later this morning. Thanks a lot for organizing the summit. I think it's a great idea. And it's always funny when I hear the sort of Central and Eastern Europe, and then I look on the map and I realize that I actually come from a country, the capital of which is to the east of Warsaw, and only about a 1.5 hour flight from Kiev, basically from Helsinki. But I guess Finland has always been defined as being somewhere up there in the northeastern corner of Europe, with a comfortable 1,300 kilometer border with the former Soviet Union, otherwise known as the Russian Republic, at the moment. Now, I've been allotted roughly 10 minutes to give a couple of introductory remarks, and let me do that. And let me preface with what I'm going to say with the thesis that I do think that there are three mega trends that are interlinked at the moment, which all of us in both policymaking, in academia, in civil society, in government, in the private sector, wherever we work, are grappling with. And perhaps in the most important order, they are climate, health, and technology. And as you said, without solving the climate issue, it's very difficult to solve the health issue. And without climate and health, you basically, without technology, you can't solve either. So my thesis today is that when you look at sustainable finance, when you look at climate, look at it from as broad a perspective as possible, and please bring in both governance and technology into that conversation. I think the interesting thing with the fight against climate change is that, you know, you can say nowadays that roughly 90% of the globe agrees with you. I mean, obviously you have a few people who still are in climate denial, but they are few and far in between. Some do it for political reasons. Some do it from lack of understanding. But I think it's sort of a megatrend argument that has already been won. Now, so everyone agrees there's a problem and everyone agrees that we need to do something about it. But I think where the disagreement, a lot of the heated debate comes out is on how to do it. And I'll try to sort of dissect this in a moment. Obviously, with a general approach, you then have many different ways of dealing with it. You know, one is to be condemning, condescending, and in many ways, you know, trying to shame people into action in climate change. And I'm not always convinced that works. Then there are others who sort of think that it's, you know, it's sort of a quasi problem and you really don't need to, you know, push it that much. I'm always trying to find a sort of middle ground between the two. You probably need, you know, people coming from all quarters, all walks of life in dealing with it and raising awareness. Now, the nice thing in my current job is that I actually have a life. In other words, you know, when you leave politics, you have much more time to think, read, and reflect. And at this particular moment, if I were to recommend one book to read in this field, it would be this one here, Bill Gates' latest book on how to avoid the climate disaster, the solutions we have, and the breakthroughs we need. Now, some of you will probably be experts in the field and think that that's too basic. I actually think that basic is always quite good. You need to go into the basic figures. And one of the nice things that Bill Gates does in this book, and remember that he comes obviously, you know, from a private sector successful background, moves later into philanthropy and basically civil society and tries to solve various issues, not only health related, but also climate related. And his basic thesis, which he says here, is that, you know, there are two figures that we need to understand. One is 51 and the other one is 0. And to simplify things, the 51 is 51 tons of greenhouse gases that we emit per year. And 0 is where we need to get to. So this is sort of not the only way we solve the climate crisis, but, you know, again, simplification is quite useful because, you know, when people talk about billions of tons, which I just forgot to say, it's 51 billions of tons of greenhouse gases per year, you get lost in the figures. So just to give you an easy rule of thumb here is to say that we emit on any given year roughly 51 billion tons of greenhouse gases. Last year, because of COVID, we ended up emitting a little bit less, roughly 47 billion tons, so 4 billion tons less. So this gives you a ballpark figure. Now, what I find quite frustrating with the climate debate so often is that it's a sort of naming and shaming and the basic idea that you as an individual are the only solution to this. And, if you take a car, you're a bad person. If you eat meat, you're a bad person. If you fly, you're a bad person. And I'm not sure this is the best way to go about it. So that's why it's always good to look at figures. And what Gates does in a really nice way says that there are basically 5 key emitters that we need to focus on. Number one is making things. So that's basically cement, steel, and plastic. So the stuff that we build from a make, that's 31% of the 51 billion tons, 31% making things. Number 2 is plugging in. So electricity, that's 27%. And I know that's quite shocking. And we quite often think that electricity is clean. Well, it's clean only if it's made out of something else than coal, right? So electricity is a big issue here. The nice thing is that 27%, yes, but it's also then 27% of the solution, and nuclear and other solutions, renewables are there. Thirdly, growing things. So plants and animals, that's 19%. Plants and animals. So our romantic notion of farming and eating, etc., it's not a very pretty picture when you look at the amount of cow farts that are around, etc., etc. The fourth one is getting around. So that's you and I getting stuff and moving around. So planes, cargo planes, of course, trucks, cars, cargo ships, etc. That's roughly 16%. And then finally, the fifth one is keeping warm or cool. So basically heating, cooling, and fridge, that's 7%. So the rundown of the list that we need to focus on is number 1, making things, 31%. Number 2, plugging in, 27%. Number 3, growing things, 19%. Number 4, getting around, 16%. And number 5, keeping warm or cool, 7%. And here's the catch: we need to find solutions to all 5. So that's why it's not worth only focusing on one. All 5 need to be solved in one way or another. And the reason for this is very simple. Energy consumption is going to continue to increase. I mean, it's basic, I guess, physics, in the sense that as the population grows, as the demands grow, energy consumption. So then the question is, how do you do it? Okay, here, and this is where I come to the crux of what I'm going to say. We basically have 3 solutions to this. The first one is zero growth. So that's, basically saying that, well, look, we did quite well here, during the COVID crisis, that we reduced by 4 billion tons out of 51 billion tons greenhouse gas, and we can continue to go to. But of course, it's a non-solution. It's utopian, and in any case, it doesn't take us to zero. So that it's a non-solution, if you will. Secondly, there's a school of thought which is, to a certain extent, if I simplify, quite European, and that's legislation or targets. And that's why you keep on hearing about percentages and rules and regulations, and that's why you have carbon pricing and so on and so forth. And fine, legislation is an important part in terms of being an incentive. And then finally and thirdly, I think the key solution here is technology and innovation. So basically what you need is three things. You need the activism, the people who talk about, zero growth and the rest of it. Secondly, you need the politics and the public sector, which basically makes the rule. But thirdly, it's the private sector that's going to give us the solutions through technological innovation. And here's where I would like to see you speak about this week is, how do you finance this innovation? And I must admit, I'm quite subjective on this, but I did work for 2.5 years for the biggest multilateral bank in the world. It is called the European Investment Bank, so the EU's bank, which is now in a process of converting itself into the #1 climate bank in the world. And there the logic is very simple. You finance projects which help us in our fight against climate change. So it's in many ways a public and private endeavor to make sure that there is enough blood in the bloodstream, in other words, money in the innovation stream to get things going. So this, Linda, was what I wanted to say in my 10 minutes. There are no easy solutions. This is going to be difficult. It's going to be frustrating. It's going to be tough, but I do think that it is doable.
Thank you so much, Alex. I mean, I couldn't agree more with you. It's interesting also to see these numbers in terms of what we need to do and what the challenges are, because without tracking our progress, it's also hard to say how well we're doing. And I think EIB turning into a climate bank is extremely exciting. And it will be interesting to see how we can actually figure out these private public partnerships, because we definitely need to scale up private finance. But thank you again, Alex, so much for joining us today. It's fantastic to hear from you and also to see what amazing work is getting done at the School for Transnational Governance, especially with the climate cluster that's publishing actually a range of very interesting publications that I would strongly advise people to check out if they want to understand what's happening within the EU policy space. But thank you again, Alex. It's a pleasure to have you here. So,
okay,
actually,
sorry, thanks a lot. I really appreciate it. I'm sorry I have to leave. I already saw that someone said that nuclear can't be seen as a solution. There might be some people that disagree on that. But surely you'll have a good discussion on this as well. And good luck with the talks.
Thank you so much, Alex. Thank you. Yes, I think it is interesting. Nuclear is always popping up in this conversation. So we will definitely be discussing that at one point sooner or later during this conference, because we do have an entire panel on energy financing. But thank you again, Alex. Pleasure to see you and see you soon. And next up, we also have Sagarika Chatterjee, who is joining us from the UN Principles for Responsible Investment, who will do a few remarks telling us about the great work getting done at PRI and also as part of the preparations for COP26. So currently, Sagarika is actually co-leading on finance for the COP26 high-level climate action champions. And is actually co-heading also the Secretariat for the UN-convened Net Zero Asset Owner Alliance, which is a very important initiative trying to drive private finance towards net zero and towards Paris alignment. So thank you so much, Sagarika, for joining us today. It's a pleasure to have you. And please, the floor is yours.
Great, thank you very much, Linda. I'm really delighted to be here today. So I thought what I'd cover initially is why the time to act is now, a little bit about the COP26 campaign called Race to Zero and how you can get involved in that. And then thirdly, a little bit about recent developments that we're seeing. And I'm going to cover in that a little bit about coal phase out and also a little bit about finance. Firstly, on why the time to act is now, and I'm going to really address this in terms of how the UN is viewing this in the context of COP26. And as I say this, I'm really aware that all the colleagues on the line have very much been grappling with coronavirus and the anxiety that there is through Europe and elsewhere about the new Indian strain, as well as the sympathy that we have, and particularly myself as part of the Indian diaspora with what's happening in India, and that being the context of COP26, the next meeting of the Paris Agreement and all the 190 plus countries that are in it. So as this audience knows very well, in terms of where we are, the Earth is now 1.1 degrees warmer than it was, and on current pathways and current commitments from governments, we're expecting to see temperature rise of 3 to 5 degrees by the end of this century. A safe amount, as you all know, is 1.5, and the best chance for the planet of getting to that 1.5 and restricting it at that level is to have net zero greenhouse gas emissions by 2050. And that's a really key point for what I'm going to say next about the race to zero and some key developments in finance. So in terms of COVID and recovery, I think we really have a choice, and it isn't a very clear choice, and there are many, many shades of grey within this. But that choice is effectively, are we going to continue as we did before? Or are all the market changes that we see across sectors and across countries going to be the turning point, and an important turning point for reducing energy-related emissions, for smart buildings, for green transport, and all the changes in agriculture, as Alexander was mentioning. And right now, it's not clear that we are going to make the most of this potential turning point. So the International Energy Agency, as you know, has said that emissions are set to rise in 2021 and will be the second biggest emissions leap on record, whereas the United Nations has said we need to decrease fossil fuel production by 6% each year between 2020 and 2030. So as you all know, the real action lies with governments. So where are governments? So governments, as you know, every 5 years, if they're parties to the Paris Agreement, they need to submit their nationally determined contributions or their country pledges. And that's the really important bit. You know, the meetings, the Paris Agreement, the COP26, it's all very, very important, but the devil really lies in the detail of these domestic emissions reduction plans. So today, 102 countries, so there's 190 parties in the Paris Agreement, 102 countries have not updated their nationally determined contributions. 6 have proposed new ones, and of those, 5 are stronger. 56 countries have submitted new nationally determined contributions. That includes 55 countries and the EU 27, which I'm counting as one country. And 13 of those 56, including the EU 27, are stronger. And those stronger nationally determined contributions are include from the UK, USA, which is obviously critical as one of the highest emitters, the EU, also critical, Norway, Costa Rica, Chile, Kenya, and there's a raft of other ones. So the big question mark obviously is around, will China raise its ambition over this year? China, as you know, has committed to carbon neutrality by 2060, but we would need to see more to reach that goal that other countries and high emitting regions are moving towards, which is net zero by 2050. Just a quick recap again then of net zero, as this is now becoming a really key concept that we're starting to see be socialized and normalized in the finance sector across geographic markets. So net zero, as you know, means adding no new emissions into the atmosphere. Emissions do continue, but they have to be balanced by absorbing an equivalent amount from the atmosphere. So is this possible? Well, according to our scientists, the technology does exist for net zero, and some key areas include powering the economy with clean energy, thinking again about how we can replace coal, gas, oil-fired power stations with renewables, not easy, switching to electric transport, which also gives the benefits of better air quality, electric vehicles becoming more efficient and cheaper, agriculture, livestock, which produces methane, a key greenhouse gas being introduced, and also removing carbon in the atmosphere. And nature-based solutions will play a key role. So that includes things such as forests, which are highly efficient at absorbing carbon. And furthermore, the UN's view is that the green economy could in fact yield some economic gains, estimated at $26 trillion compared to business as usual. So much for giving you the kind of the context for COP26, which will be in November in Glasgow in the UK. We're anticipating it will go ahead in some form. It may be hybrid, there may be less people. Vaccinations are obviously going to be key, and developing countries, just speaking in a personal capacity, would need to see that many of the domestic problems they have at home have been partially resolved or on a good track, I believe, before this can be a very successful COP26, but the plan is to go to head. So against that, I want to update you on the Race to Zero, which is a global UN campaign to build momentum and rally leadership from cities, regions, the finance sector for a healthy, resilient, low carbon economy. And the Race to Zero campaign basically is for everyone that is not a party to the Paris Agreement. So it's everyone in private sector, but is not a government. But governments, as I mentioned, are really key. So Race to Zero is a coalition of net zero initiatives. Today it has in it 708 cities, 23 regions, over 2,000 businesses, and over 160 investors. Altogether, those actors cover 25% of CO2 emissions and over 50% of GDP. So really, really significant, and highlights the important role that those of us that are not governments can also play. There are ways you can get involved in the campaign. So you need to join an initiative that is part of Race to Zero. So no matter what kind of an actor you are, as long as you're not a government, there is a way that you can join Race to Zero. And what's the purpose of the campaign? Well, we're really racing against time and ourselves. So it's not a race against each other, but more racing for a better world. Now, there is one important caveat, which is to join Race to Zero, you can't just say, yeah, I love net zero, like, yeah, I'm going to join Race to Zero. Because this is a serious campaign and it's about reducing emissions and getting to net zero by 2050, there's some criteria that any initiative has to meet. And this criteria kind of starting to give the guiding star to what good practice is. And this is relevant to the finance sector. So I'm going to cover it. Linda, is it okay if I just go into it a little bit, the criteria? Very good. So it covers 4 areas: pledge, plan, proceed, and publish. On pledge, any initiative and any organisation that's part of an initiative, that's part of Race to Zero, needs to pledge to having net zero greenhouse gas emissions by 2050 or sooner. But the key bit is interim targets. We can't wait till 2049. So an interim target means a near-term target that is around 2030, if not earlier than that, 2025. And it needs to cover all greenhouse gas emissions and scope 3. So that's a big section that's all around targets. Then the second bit on plan, so you need to have an action plan that covers the next 12 months, and that will be also covering some of the social dimensions, because the people, the equity, empowerment components of this are really important. Whether you're a company that has customers, you've got to think about fairness, or whether you're a business that's in a high emitting sector, and you have to think about the workers and communities that are dependent on fossil fuels. And then proceed means taking the action, the difficult bit. And then publishing means publishing, reporting publicly on how you're progressing against those targets. So some of the themes that are covered by the campaign and the staff that are providing almost like the secretariat behind the campaign include people, waste, water, human settlements, industry, finance, land use, oceans, transport, energy. And what the staff behind the campaign are looking to do is convene key actors behind these themes across different industries. And you'll find online some publications on what's needed for the sector breakthroughs. So just turning then to some key developments, I'm going to very briefly cover, and Linda, I know I've got 1 minute left. So key development I wanted to highlight is around coal phase out, where the UK has gone from generating 40% of electricity from coal to less than 1% in under a decade. And I think that's an interesting example because they've also tried to combine many of the people aspects of this. The last thing I wanted to mention as we finish is we just launched at President Biden's Climate Leaders Summit, which was on 23rd of April, the Glasgow Financial Alliance for Net Zero. So this brings together over 43 banks, over 40 asset owners, and over 87 asset managers that have set net zero targets, including meeting the criteria that I just mentioned. And together, those banks, asset owners, asset managers will be working and also bringing in insurers soon towards net zero by 2050 and earlier than that, thinking about how they can strategically coordinate, how can they tackle some of those key themes I mentioned, how can they get to sector breakthroughs, and how can they work alongside governments towards the net zero goal. So I very much hope that you would look to get involved in our Race to Zero campaign. You'll find a lot more information on the website, and I see Linda's dropped that into the chat, and I hope you have a fantastic next few webinar sessions as well. Linda, thank you very much.
Thank you so much, Sagarika. That was fantastic. I think that's another very interesting development in the sense that I think that we are speeding up the race to zero. At least we have been trying to. There's been a lot of conversation. So now I think the big difference will need to be that we actually need to shift from talking to doing. So this should be the decade of action. And action sadly can't happen if there isn't enough money around, and if we can't figure out how to finance these things and how to create these mechanisms that channel money towards where it's most needed and to pay for the transition that we need. Because it will be about transforming our industry as it is. It will be about changing how we pay for things and what gets finance and on what terms. And for that, we need much more efficient capital markets. And that brings us to our first panel this morning, where we will be joined by 4 fantastic speakers with different backgrounds to discuss what needs to happen with capital markets, what is happening, and what are the challenges that we're currently facing. And first up, we will hear from Mr. Martin Hojsík. He's a member of the European Parliament for Renew Europe. We also have Katarzyna Szwarc joining us from Poland. She's the representative for capital markets at the Finance Ministry. She was formerly with LSE Grantham and a variety of other roles, including Warsaw Stock Exchange. We have Lubomír Vystavěl joining us from Prague, I believe, where I should be going over summer, back to the wonderful capital. He's the Chief Investment Officer and Chairman of the Board for NN Investments. He is also Chairman of the Board of NN Investment Partners Czech Republic. He is managing clients and investment for clients in Czech Republic, Slovakia, Hungary, and Romania. He was also previously at Moneta Money Bank, which was formerly known as GE Money Bank. And I think he also did a stint at Ernst & Young. So again, a very diverse set of experiences. And finally, we're joined also by Jana Bradani, who is the Executive Director of Czech Capital Markets Association. She's been involved in capital markets in Czech Republic very intensely, also including in the wider Visegrad region. She has done work on the legal and tax consulting side as well, and she's been the board of directors of the European Fund and Asset Management Association, representing Czech Republic. And she's managing the activities of the CFA Society in Czechia as well. So to kick us off today, we will first hear from Martin, who's joining us probably from Brussels, but I might be wrong, but I'll let him introduce himself and start off with a few remarks about what is actually happening in Brussels and what's happening with the Green Deal. Please, Martin.
Good morning. And if you want to see me, I think as a host, you have to turn on my camera because somehow it tells me that I cannot do it myself. And thank you for the opportunity to be part of this conference. I think it's really thrilling that we are finally bringing the topic of sustainable finance into the Central European region. And as an illustration, I remember a few years ago, and actually still, when I was asking my banker whether there is, when she was doing the regular round of trying to offer me investments into funds, I was like, okay, is there anything sustainable? And no, there wasn't, and she didn't have sadly much clue about what I'm talking about as a kind of this type of investment. And that's, I think, is one of the challenges. But the other challenges, and that's maybe to some extent the Slovak specialty, that the capital market in Slovakia is halfway dead, and would be nice to see the revived, or maybe to go and try to foster a bigger collaboration between the capital markets in the region, because at the end of the day, as one union, I think we should be able to work better across the borders. Now, last week, I saw the data that the Slovak Hydrometeorological Institute came up with. It was not their data, it was based on the Copernicus data. And the sad reality is that if we go by this speed, we'll hit 1.5 in 2034. Which is, if I'm not mistaken, 13 years. And this is something which we have to realize is, I think, a really, really crucial issue that we're facing. And that issue that we need to start addressing, as the previous speakers said, this is not about talk anymore. This is really about action. This is really about putting our money where we say they want the change. Now, I would be, I could talk for hours also about where we have problems with the spending of the governments. But I think here, and this is something which is really often under-discussed, is how there is not enough investment into sustainable investment. And I let the next panel to go into the wonderful topic of taxonomy. But I think the taxonomy provides a really good basis also for the capital markets to finally know what is green investment. Hopefully the delegated acts that are coming will be sufficiently scientifically linked, because that's the risk we honestly face, and will create a space for a number of issuers to come forward with products that will be providing an interesting opportunities. Now, I think on this side, yes, we need to create this kind of the demand for finance. There is something to be invested. There needs to be some vehicles to invest to, into products to invest to, in terms of having issues on the capital markets. At the same time, and I would like to really hear this from the co-panelists, there's also the lack of on the side of the financing. There is lots of money in the pension funds, for example. And yes, large part of it is settled into very conservative investments, but not all of it. And I think this is something where, from my own perspective, I would be keen to invest into kind of more share part of the pension fund, but I'm stuck in the very conservative because I don't have a guarantee that my money will not go to actually these activities which I don't think I should be supporting in my pension funds. So that's also the supply side, and I think there is a big need, and would be keen to hear what are the institutional maybe barriers to creation of products for the consumers, so to say, which would allow them to invest on the capital markets into sustainable products. And I think this is something where we have to be also very, very careful when we go for this, that, and also looking at the taxonomy, that we prevent stranded investments and that we prevent a situation where we invest into ultimately greenwashing. The two examples of the risky areas, I'm not going to go into the nuclear discussion, that's kind of for really would need a separate workshop almost. But one is, there is quite a big discussion about the gas and to which extent the investment into the gas and gas infrastructure can be deemed sustainable. In taxonomy, it's seen as a transition activity. And there I would kind of warn against not looking at following the hierarchy. So going first for the energy efficiency, then for renewables, and only then covering the rest with gas, because it's a fossil fuel, and looking at the kind of the return times, there is a high risk. We need to switch it off by latest 2050, honestly earlier. So there is a very high risk, especially in the infrastructure investment, that it's not going to be paid back. And the second, for me, kind of risky area is example of the, so to say, false solution when the municipal waste incineration, even with combination with energy recovery, is labeled green, yet it is also a source of fossil emissions. It's not essentially renewable energy because you burn fossil fuels, especially in connection with the plastic, and it's not the best solution under the waste hierarchy. So as an examples of, there is a need to increase the demand for such a funding, but there is also need to increase the supply. And we need to be aware of risks of stranded investments and really, I would say, halfway greenwashed solutions that will try to put on the market. Thank you.
Thank you so much, Martin. It is indeed, nuclear seems to be a topic that's of great interest in the region. And I think maybe in the future, we will have to actually organize an entire session just having a very pro versus against conversation about it, because it is true, it can be seen as green, but also, as we've seen with so many examples lately, it's just so costly money-wise. And yeah, it's an expensive thing to take on. Not to say that governments haven't done it in the past, right? It's a political decision. So we also have to
just to add on it, this is something where, you know, for me, one of the amazing things about the sustainable finance, especially in terms of renewables, this is not anymore, oh, we have to subsidize and then do it because it's supposedly a good thing to do. We are in a situation where renewables are pretty much the most efficient and most also investment worthy, because they're simply becoming so much cheaper. And this is where I believe we should really look also on the money side, and nuclear is just too expensive.
Yeah, I mean, I would tend to agree with that, which is actually will be interesting to hear now from Katarzyna, who's worked on actually transitions, right? How do you create these transitions from polluting energy systems to maybe more green energy systems? And your work on transition bonds and a variety of other financial instruments at the LSE Grantham has always been extremely fascinating. So welcome, thank you for joining. And I would love to hear, Katarzyna, your thoughts on now that we are in 2021, now we're hopefully seeing the pandemic subsiding a little bit, economies are opening up. So we would love to hear your thoughts on what can capital markets in the CEE do a bit better, especially with your new role, which is very topical for this panel.
Thank you very much, Linda, and thank you very much for having me today. It's a pleasure to join the conference, to share a little bit of thoughts about green finance and how capital markets can support the transition towards net zero. Indeed, as you mentioned, since the beginning of April, I have been appointed the High Representative of the Minister of Finance in Poland for the strategy of capital markets development. But as you've also mentioned, in my previous job, I've covered extensively the sustainable finance topic. So let me take a step back, because to where it all starts in my mind, which is to the Paris Agreement, which emphasized that global financial flows and thus capital markets can and should align with the climate protection objectives. And indeed, as we have seen over the last few years, the capital markets around the world have started to adjust. We've seen a great increase in the issuance of green bonds and instruments such as exchange traded funds dedicated to climate or social aspects. These were created in large numbers, and their volumes are growing. We've also observed more transparency, which was not only due to more regulation and policy, but also due to investors that started paying attention to factors such as environmental, social, and governance aspects. Organizations such as the Net Zero Asset Managers and Net Zero Asset Owners Alliances have emerged, and these were the same for other parts of the industry. Importantly, we are also seeing now the regulators and central banks catching up with that. So I think that there were three key factors that, in my view, contributed to this. First of all, it was regulation and policy, with the EU leading the way, but now the US also catching up, as well as Asia. We've seen greater emphasis on the climate risk, where banks, insurers, and other financial institutions started waking up to the fact that climate change may affect their portfolios. And indeed, this year, the Bank of England will be the first central bank to run climate stress tests. But last but not least, it was also public pressure, because investors, especially the big ones so far, to be clear, started voting with their money and saying, we are not going to invest if you don't have a credible decarbonization plan. Now, interestingly, coming back to capital markets, the traditional financial centers are not necessarily the ones to be leading the way in green finance. In fact, according to the Global Green Finance Index, Amsterdam and Zurich are on the top of the league, with London, being the traditional financial center, coming third, and the New York City only 31st. In CEE, leaders are Vienna on the 22nd place and Prague on the 67th. There is, though, a lot of room for improvement. For example, in Poland, which was the first ever country to issue green sovereign debt, only a handful of emissions took place since then. So in my view, we need to start thinking in the CEE about building green finance hubs here. And in my view, there are four key elements of building a successful green finance center. So first of all, it's about transparency, the availability of reliable and detailed data in line with commonly used standards, allowing investors to make decisions in line with their ESG preferences and internally classify assets as sustainable or clean, if you like. So this is also the key condition for preventing greenwashing effectively. Second of all, it's about financial instruments. These are and this is what we would say are ESG compliant products that enjoy great popularity around the world today, but for many reasons, they are not yet a big part of the assets in our region. For example, the demand for green treasury bonds, even in the case of countries with lower ratings, exceeds the supply even several dozen times. So these are the types of instruments that would allow us finance the transition towards net zero, while also providing investors with an opportunity to invest in that great project. Third of all, it's about institutions. So it's first the existence of professional service providers specializing in ESG matters, which is necessary to fulfill both of the above demands, to be honest. But second of all, it's also about the regulators keeping up with these developments. We've seen great examples of that, for example, with the BaFin, the German regulator guidance notice on dealing with sustainability risks, but also with French, the regulator, the FCA, issuing their own. So there is a lot of movement in that space, and other regulators should catch up. But it is not only about compliance, to be fair, because it is also about supporting market participants in introducing new green products and new solutions. And this can be done, for example, through regulatory sandboxes. Finally, what I would like to say, it's about public policy, meaning both regulation and incentives, which are important factors in the development of sustainable finance. And the former the regulation is currently being picked up by the EU. So we've heard a lot about the new strategy, the renewed strategy on sustainable finance, but also, as mentioned by the Commissioner McGuinness, the Green Capital Markets Union. Second of all, it's also about national level actions. And here I would definitely mention the recent sustainable finance strategy adopted by the German government. A similar one was in fact adopted in the UK back in 2018. Now, these all aspects will need to be taken into account when building green finance centers here in the CEE. In Poland, back in 2019, the government adopted the capital markets development strategy, and it's been since implemented beginning from 2020. The strategy includes a number of goals related to green finance, such as analyzing the possibility of developing a green bond market in Poland, not only focusing on sovereign instruments, but also corporate and municipal bonds. It includes a number of goals to educate and promote sustainable finance, as well as improving transparency in the ESG sphere by launching a new carbon benchmark. So this strategy is the first step that we are taking, and we will continue to cautiously implement it. But it would be really interesting today to have a thorough discussion about other ideas and solutions on how capital markets can contribute to the transition towards net zero.
Thank you, Katarzyna. I mean, I really believe in regulatory sandboxes. I think it's a very interesting term and idea, because sometimes we just don't know what might work out best. So I do like that idea. And in the CEE, I think it's a very interesting fact that actually Switzerland is quite an active sustainable finance place. They have quite a lot of different initiatives that are working on this, including sustainable finance centers, and centers that don't have actually sustainable in their name, like we do, but actually they work and focus on figuring out essentially how long-term financing can contribute to prosperity, and they see it as pretty much necessary thing. Just like with Japan, where the government pension fund actually takes 100-year horizon and then starts investing. And we've recently acquired a specialist data provider on gender because they decided that gender might be quite important in terms of how finance plays out. So actually, we now have a great opportunity to hear from somebody who has been in the finance space for a long, long time and has had to work across the region with investing and with asset management. So we're extremely happy to have Lubomír Vystavěl with us, who's going to tell us about what does it actually feel like to work in finance in the region, and what are the changes that you've seen, and what are the challenges that we still face to create maybe a more ESG aligned investment, even if currently it's a little bit of a term that's under attack from all sides. So please, Lubomír, thank you so much for joining us.
Thank you very much, Linda. Thank you very much for the opportunity to speak here, and it's a great privilege to be in this audience and this panel and to present next to you. I hope that you can hear me well. I also prepared some slides. I don't know whether we can show them and whether I could move them around or not. But
of course you can. I will let you do it yourself, because I think it's always so much easier if somebody who actually created the slides gets to guide our eyes. So just one moment, let me see the controls, and we're going to enable you to do that. Just a moment. Okay.
Well,
okay, apparently you've been made a host, so you should be able to share. So if you give it a shot, if not, then I'll share for you.
Okay. Let's see what I will share if I do that. If I share the full screen, or if I'll just share the window. Yeah, okay, this should work. Let's see.
Yes,
you see
it is working. Yeah? Yes,
okay,
we can see it. Perfect.
Wonderful. So basically, the finance is not living in the out of touch with what is happening in the world and what is the reality, and the evidence of what the world is saying about finance and about what are the risks. And the finance is always addressing the pains or the needs of the investors and the population through various ways. In this survey of the World Economic Forum, we see the global risks perception. This is the latest one published in the beginning of this year, showing how prominent environmental threats were in 2020, with really environment issues taking top 5 place in terms of likelihood, and top 3 or 3 out of 5 in the impact to the world. This is the result of the latest. So we see that the infection diseases have taken obviously quite a prominent spot because of the COVID. In terms of likelihood and in terms of the global risks, we see that the weapons of mass destruction are also, and infection diseases are, in terms of the impact, quite prominent here. The climate action that we have discussed previously is taking second position in terms of impact, followed by biodiversity, natural resource crisis, and human environmental damage. But also sustainability in terms of social aspect is taking prominent role in terms of livelihood crisis, and this is impacted here in the risks of digital inequality or digital power concentration. They are seen as big risks in the world. So the world of finance is not staying aside in trying to resolve this, because it sees demand for the products that will be addressing these type of issues. And we see on this chart, which is compiled from the Morningstar data at the beginning of this year, showing how much the sustainable finance fund flows have been increasing over the past years. We see that really it is coming from a low levels, and the prominence of these discussions is growing enormously over 2019, 2020. But over the last year, it's a huge jump in the fund flow that is dedicated to these investment vehicles. We also see that Europe, thanks to, as was also mentioned, a lot of emphasis and recognition of this is gaining a lot of prominence in these flows. But we see that the US and the rest of the world is picking up in this form of investing as well. I think it's important to see that the sustainable assets, or assets that are dedicated to sustainable investments, are also having above average performance. So we can see that the assets that are actually driven by social responsible investing or that or ESG criteria that are more aligned to these goals actually had much better performance over the last year than the traditional MSCI. MSCI is here flat with 100% flat line, and we see that the social responsible investing is actually having quite a gap to this index. But we see this also on the ESG focus. We see this on ESG leaders or other assets that are assigned to sustainable type of investing do outperform the traditional assets, which is very important because very often in the discussion that we face with the investors, it's discussion, maybe it is especially from this region, but I would say it's not the only region that actually poses the question: does investing sustainable mean that it's actually giving up the results? Does it mean that the return that we will have on our portfolio will be below the traditional assets, or let's say SIM stocks? You've seen the studies about SIM stocks outperforming the sustainable funds. Well, this is MSCI indices data over the year, which I think would be recognized as objective view, and I guess there may be different studies that would show different conclusions based on who might be financing the study or not. This is market reality. This is what we have observed. This is objectively calculated. I think it's a false myth to see that sustainable data are underperforming, and we believe at our organization that we can actually generate substantial returns, at least the market returns, but we can add also something extra if the sustainability is carried. And we believe that there is actually premium that the sustainable assets can actually generate, because those assets will not be penalized in the process of the years for doing harm to the society, to the economy, ecology, or to the workforce. So in our view, it's all these three letters, E, S, and G, that are important. So it's not only the environment, it's also the society and the governance that is important, because we believe that actually the governance is actually the one that is driving the first two letters in this abbreviation. That is so important to see how sustainable that investing is, or the vehicle is. Okay. This is also another chart which is showing a slide which is showing how the sustainable assets have been performing in stress environments over the years. It's a bit older data, but I guess it's not wrong to use it in this and to show that even in the energy downturn, the sustainable assets have been performing better, or 78% of those indices that were tracking those benchmarks have outperformed. The Fed policy reaction in 2018, in the COVID crisis when it started, it was very prominent that these assets are performing better. And later on, during the year 2020, this was also the case. So looking at how we as investors are addressing these issues and how we look at responsible investing, we have developed this approach on looking at restriction criteria, which are probably the best known concept in the responsible investing, on how to actually eliminate companies that actually are seen as doing harm, like controversial weapons, tobacco production, arms trade with entities under embargoes, thermal coal mining, oil sands. It would be primarily under restriction quarter of this pie. Then there would be other, depending on how sustainable the strategy would be, also elimination of a lot of these criteria of undeveloped Arctic drilling, or shale oil gas, nuclear energy, weapons, and so on. We see that there are important elements of this ESG integration that actually then make these additional criteria important to play in the investments and how they impact the investment vehicle and how they contribute to the sustainability overall. And there is in this parameter there is engagement and voting, which we see as very important on how companies and financial institutions actually how they make sure that their investments are actually performing in the right way or are changing the attitudes towards better future. And that's where it is important to see that we as investors have obligation to vote in the interest of all the stakeholders in terms of the investors, the society as a whole. And I think this is the most important role that the financial institutions that actually hold these financial assets, that they can actually exercise in changing the world environment. And then obviously that goes with the transparent reporting on how companies actually, investment companies, how they report on their activities, but also how, and was also already mentioned, how companies themselves, how they are asked or how they are demanded to report on their on various criteria. And here regulation, for example, SFDR, is actually playing a prominent role in actually acquiring companies to make certain disclosures and to make it easier for investors to orient themselves and to use this data in their investments. So out of the 5 trends that we see here is that there is a bigger client focus on these activities. We see that the investors are increasingly recognizing the need for urgent action. We see that there is a growing cross-country collaboration on the specific issues, at least in our region, that is within our organization, that's clearly the case. But we see that also conferences like this contribute to this cross-regional efforts. We see that investors are using more tools to influence companies, to collect data through voting, through engagement on the board, but through direct dialogue with the companies. And we see that also there is more regulatory action to shape the industry, like the SFDR already mentioned. I'll try to go through this slides a little bit faster. As we as a group manage roughly 300 billion assets, and out of these, we have roughly 80 billion in traditional strategies that are applying the responsible investing criteria, voting and engagement. So those responsible norms. And then we have more than 2/3 of our assets, actually 74% of our assets, actually either in ESG integrated strategies, sustainable strategies, or impact strategies that are actually contributing as well to better future. We as an organization, we have a long tradition with this. We started before 2000 with sustainable equity funds. We have moved on to sustainable credit index solutions, which also play a role, although slightly lower than the active managers, but they can also contribute to better future. And there is also some role for the passive investments in the field. Then there is the green bonds that we have launched in 2016, sustainable multi-asset, impact equities, and other products that are evolving in the range. In private debt are more, say, not visible as much products on the market that are seen as alternative, but they are very important because also there it's important to measure, although the data to collect on those data, on those companies is more difficult to obtain. We have recently launched corporate green bonds, and actually this year we have launched a sovereign green bond fund. So that's this range of products to sustainable investing is growing on our example. And these are the achievements that we have made over the 2020, and as I said, I'll just spend some time on some of them. So I mentioned that we have 74% now with ESG integrated and target 80% of assets under management to be ESG integrated. They have been assigned A+ score from PRI, which is an organization of the asset managers that is making efforts into making asset management in a sustainable way as permanent as possible. We are engaging with new investment vehicles, and we are growing assets in these with 1 billion sustainable credit, 3 billion in green bonds, which is I think the largest green bond fund in the world now. And we have started a new cooperation with in Asia with China AMC on the ESG investment vehicle, because it's a developing world, and where also our contribution to catching up with other countries is playing a role. We are obviously tying up with other players, and we are doing efforts on increasing the awareness of the responsible investing, on how this actually contributes to the better investments, and actually how it helps also achieve better results or better returns, because we believe that it's actually hidden alpha behind the better investment, better and sustainable investments. We believe that those can actually generate better returns than the traditional assets, as I mentioned. We also launched annual reports on sustainability. So it's a responsible investing report. This is I think second or third edition that we have done printed this year. So it has a lot of data on how we do these activities. The engagement is very important. Here's a slide that actually shows on how we actually engage with companies. So we currently engage with more than 600 companies worldwide on primarily these topics concerning the strong governance, which we believe is very important, also on the sovereigns, because in the emerging world this is a big issue, not so much issue with in Europe, but in other countries, especially in emerging markets, this can be quite an issue, and also important to realize how big impact it can have in countries like Brazil, or countries in Africa or Asia, where they are resolving first how they actually grow the economy, and then thinking what sustainability effect it has. It's important to show them it actually is combined and actually has both features can actually lead to the same result. This is a concern on the climate and natural resources, and also what is important in our view is recent work, so living wage and child labor elimination in the world. So this is going on the engagement, on voting, how we engage in voting on the companies. We have voted on more than 3,000 AGMs or meetings within the companies, again across the world. On reporting, on how we report, on how our investments are contributing to the United Nations SDG goals, on how different assets can be assigned to fulfillment of those activities. And there's we are partnering with a lot of organizations which do have a lot of expertise and can help us and in cooperation, which has been mentioned here, because I think it's very important that we have this political changes in the world where we see that there is more collaboration available, and most notable one was obviously the change in the US and rejoining the Paris Agreement by one of the biggest nations. That's, I think, very supportive and very good to see that this turnaround is taking place. So there's a lot of organizations that can gain from this collaboration, and we are trying to take advantage of that as well. This regulation, as ESG, is taking a lot of requirements on reporting. We have been reporting on this already before. It's important to see, for example, how the portfolios with same or better results can actually have, for example, a lower carbon footprint or a lower water demands. So this is part of the reporting that we are doing. This is the last slide. Basically, we have lots of publications also on this topic, because sustainability is one of the key pillars for our organization and has been since 2018 on the growth and development. And we engage with companies in exchanges in the region, with Warsaw Stock Exchange on helping to organize the conference, with the Romanian Stock Exchange on the recent initiative on the sustainability ranking. We try to do that across the region to bring more data onto surface and to make it a better place for investors. So that's it for me.
Fantastic. Thank you so much, Lubomír. I think it's very interesting to see how much effort you put into engagement as well. I think that that's going to be one of the main drivers of trying to push these companies also to report, because I noticed you get your data from Sustainalytics and Refinitiv, and we just finished a very large project with Refinitiv, actually. I think the report is coming out next week, and it's on the S in ESG. And what we discovered is actually that often the limitation is what is getting reported. So it's going to be interesting to see how that space changes as well, and how the EU legislation is going to, going forward, change that. Because currently you can use all the available data, but you're still not getting probably a full picture, sadly.
Yeah, maybe one thing on the regulation. I think it's important to say that it's great to have regulation, because I think it puts a lot of harmonization. Taxonomy, for example, is I think a crucial element in this, to have a same understanding of the terms and same drive for it. I think where it becomes dangerous, regulation, at least from the perspective of the professionals and the market participants, is when there is too much room for local interpretations across various countries, and you know the term gold plating, and making or leaving too much room for having local regulations, and there is about and basically do not take the chance of utilizing the great EU regulations and making one harmonized bigger marketplace. And we try to in some countries try to develop something unique, and I think that is adding enormous costs to the industry. Sometimes it's not very visible at the first sight, but the second sight, when the implementations need to take place, software needs to be adjusted or reporting requirements are coming, then it becomes an enormous hurdle that is actually increasing the costs, especially at the time when I don't think we want it or need it, and where the efforts are then actually being kind of lowering in the acceptance by the industry, because they increase the cost unnecessarily. And it's good to have it harmonized as soon as possible at the highest possible level, so that so there is an even playing field, and again that comparability across the markets is there. So that's, I think, very important.
I would agree. We want to compare oranges with oranges rather than oranges with apples, as they say, which actually brings us to Jana, who's been working on capital markets, well, for a good long while and has also very good regional expertise. So what is it that you're hearing through the grapevine in terms of capital markets development? Is there hope that potentially Prague and Warsaw and Budapest will actually keep climbing through those rankings in terms of sustainability? We have seen that there's a lot of things happening actually in Hungary, where the government is trying to progressively and actively support more development on ESG. So I would love to hear your thoughts about what's just been discussed and also what you've been thinking about these issues from where you sit.
Thank you very much, Linda. It is very interesting to hear what's going on in other countries, but I must say that I will follow up on what Lubomír has just said, because I would say that he nearly summed up some of my ideas I wanted to share with you. So I'm very happy to be with you, and I will focus on one thing which I think has not been mentioned till now. And it is, there has been said a lot about on what asset managers can do for reaching the green or the sustainability objectives. However, I would like to focus on what can be done for asset managers in order to allow them to reach these objectives. And I think this is something what follows very well after what Lubomír has just said. If we look in the history, I already remember what's a bit scary on how all these discussions started at European level. And it's been quite a number of years ago when our colleagues from Western Europe, either from UK or from France, started complaining that they try to promote ESG principles, ESG investment. However, there is so much greenwashing that they need some kind of European action in order to ensure that if something is being promoted as green, then it is really green and it is not blue. And this should be done or defined on the European level. Well, actually, the idea behind this was that it was the asset managers requesting some kind of regulation. I must note that, as you can see from the beginning of these discussions, and you have seen the presentation of Lubos, a long time before the Green Deal, there were already asset managers providing ESG investments or sustainable investments in Europe. I think the beginning in the presentation of Lubos was in the year 2000, and then following on with other actions, and this is just example of NN. There are many others providing the sustainable investments, and this is something where we can see that a long time ago the asset management industry was involved in sustainable investments. So this is how it all began, and where we are now, the regulation or the initiative is huge. We can see SFDR, taxonomy, etc., etc. But what we need is actually some kind of better and more effective regulation. It's very good, and I really appreciate that ISFC and other organizations start to look at the sustainability issue from different perspectives. And I think that the CEE perspective is extremely important. Whatever we do, we must take into consideration the specificities of this region. There are if just should I mention only several of these, it's undeveloped capital markets. Whether it is Slovakia, Czech Republic, Slovenia, Hungary, there is still much room for our markets to be more developed from various perspectives. We see a lot of gold plating on local level, where in case the European legislation is not very well written, as it is in many cases, where it does not provide enough detail, then there is a lot of room for local interpretation. And in case there is local interpretation, this is something that prevents from the full European level regulation and harmonization of various issues. Low financial literacy. We can see it also from a lower demand of local investors for sustainable products. If I compare it to my colleagues in Western Europe, it is really much lower. It's still getting better. I can see it every year, and the younger the people, the more they request sustainable investments. However, this is something that started in the Western Europe already several years ago, and we are still like getting on this sustainability issue. And lack of pension reforms. This is also extremely important in many regions, whether it's the not very lucky examples of pension reforms, of what happened to pension reforms in Poland or in Hungary, or of what is not happening with pension reforms in Czech Republic, Slovakia, and in other countries. This is something we really miss, and this is something that would really promote the sustainability issue in our region. So maybe to conclude and not to take too much time, asset managers are ready to promote sustainability goals in our region. What they need is less regulation and better regulation if there needs to be some regulation. Even in the regulation, the CEE specificities should be taken into account. I think at the last conference of ISFC, we discussed, for example, taxonomy, where in CEE region, there should be taken more consideration of transitory activities being considered as sustainable, just because our industry is more focused on the heavy industry, and we will need more transitory services maybe than in the other countries. And how this can be done very easily, I think that also CEE Sustainable Finance Summit is a place where ideas may be developed, where the CEE region specificities may be brought to a wider discussion. And I just would be very happy if the European regulators would take into consideration these ideas and would help asset managers to promote the sustainability file also in our region. That's all from me. Thank you.
Thank you, Jana. I think you've raised some very interesting points, and I'll be very happy to actually ask Martin, who sits in Brussels and is actively involved in the making of the rules, to maybe tell us, what do you think? Because I mean, we have seen a lot of discussion around how we do need to transition, right? We face maybe not actually bigger challenges. So I think that's also maybe sometimes a bit more of a myth that the challenges in CEE are bigger than they're elsewhere. Well, other countries also face pretty significant challenges in terms of industry decarbonization, especially where the industrial sector is very big, including actually Germany and Sweden and other places. And then the argument always is that, well, but they have more money. And interestingly, that's not always necessarily true either. So I would absolutely love to hear your thoughts. And then afterwards, maybe Katarzyna and Lubomír, what do you think about how can we actually transition in, I guess, socially just way? Because we have to think about the environment. We shouldn't leave people behind, because I know Katarzyna's worked on this quite a lot. And do we need better rules? Do we need less regulation? Do we need maybe more regulation, or do we need better regulation? What is the happy middle ground here? So Martin, if you would like to share your thoughts.
Definitely, and thank you for the very valuable insights. Now, let me start. Of course, we need socially just transition. For me, this is something which is a must, from a simple reason. Otherwise, you would face with the societal unrest. And the example of the yellow vests in France is exactly an example of a good intentions gone wrong. And I have for that kind of the comparison in Slovakia. I could say as a politician, we need to move away from combustion engine polluting old diesels, and let's increase the price of the diesel. But the people in the less developed parts of Slovakia that commute between the towns are using second-hand diesel cars from Germany, not because they really desire to, but because they don't have an alternative to that. They don't have, and I cannot tell them buy electric because they don't have money for it. So often it's about actually smart solutions, like really looking for efficient, environmentally friendly and economical public transport infrastructure that we need to resurrect and build up. And I think this is something which is a very important step. Now, on the transition, I might use a bit crude example, but honestly, I remember when I was visiting 5-6 years ago, Malawi, one of the least developed countries in the world. Now, that was in a time when the 3G network was still a new thing. And Malawi decided to invest into 3G, not the landlines. You could say, well, they didn't have phones, they need a transition solution, they should invest in the landlines. That's not making sense. They should go for the most modern technology. So saying in Central and Eastern Europe, well, we have to use lots of coal, and so we have to now invest billions into gas that we will have to shut down within 20 years. It's not only not making much of an environmental sense, because the gas footprint in terms of the methane emissions, when you look at the emissions in the fields in Russia and also in the US, is significant, but also it's not making economical sense when you don't follow very strictly the hierarchy of energy efficiency first, renewables second, and only plugging in some gas later. And this is what we're trying to also embed in, and it was the intention, if you look at the articles of taxonomy, of defining where the transitional role of gas can be. It's really only when you don't have a lock-in, only when you use the efficiency and the renewables first. And I think this is something which is really important to keep in mind, because it's going to be a massive financial risk. Now, and the same is for me in terms of the heavy industries. It's not only our countries. Slovakia, for example, is very industrialized. Actually, 17% of the greenhouse gas emissions of the country are from US Steel and its energy provider, which is also a fully owned subsidiary. And the large part of the manufacturing is car manufacturing, which itself is not a major source of emissions. It's actually quite modern in terms of also the use of robotics and the kind of industry. 4.0, actually, I was meeting the representatives of the car manufacturers, and they were telling me, well, we already have an industry 6.0 in Slovakia, because it's kind of new factories. The trick there is going to be more how to take them along and help them to transition to non-combustion engines, and really make sure that the industry stays cutting edge in Europe, because that's what we've been losing recently. So I'm a big advocate of, actually, yes, in some areas we have specific circumstances, but let's use it as advantage. Let's use it as a moment to really kind of leapfrog into a new energy systems, into areas that have a big potential for the region. So rather than being those who are catching up, to be leading up front. Now, in terms of regulation, we can call it smart. I think and pandemic showed us we need a high quality regulation, but it's always about looking at, okay, what is, and having a frank discussions, what is too much or what is useless and what is something which is really helping. And indeed, taxonomy comes from the desire of the financial industry to finally have clarity and rules. And you could say, well, market could have decided it. So for me, the setup of the regulation, the smart regulation, is above all about ongoing dialogue, engagement, and never-ending search for the right solution. And what is the right solution today might not be something which is going to work in 10 years. But that's why also I understand the desire for predictability and stability, but we live in a very well, in VUCA world, it's volatile, it's unpredictable, and all the rest. So something which we have to also be able to react in terms of the legislative framework. And given the speed of developments, it's not easy.
Thank you, Martin. I mean, I think that the EU taxonomy is interesting in the sense that it also will be revised ongoing. So there's going to be delegated acts. And so I think that the transition is something that is under consideration. So we'll see what happens next, because there is likelihood that maybe gas will remain in it, which then won't necessarily make it science-based, but I guess it will be then helping to transition, let's put it that way. Often we hear a lot about how it's actually Brussels rules and it's all imposed, and it's very annoying because the industry knows better and we could have done this better, but self-regulation is self-regulation, and self-disclosure is also self-disclosure, and there's plenty now evidence showing that often it is insufficient. So as Lubomír said, we need to kind of create level playing ground so that we understand what we're dealing with and whether progress is getting made. And in that sense, Katarzyna, I wanted to ask you, what is that governments can do more in the region, right? Because they know what the challenges are, whether we like it or not. The greening process will start, especially now seeing that John Kerry and Biden administration is also focusing on greening. There was a recent statement saying that, well, we need to maybe collaborate and actually, try and figure out how we make the taxonomy cross-Atlantic, which is big news, right? So, and these are big financial markets. So I'd love to hear your thoughts in terms of what are the best opportunities, next steps that the governments could do to actually help regional investors to tap into this. Because the other thing that we've noticed is that there is appetite to invest in more green or sustainable projects, but then there's a lack of origination of these projects, right? So you sit with asset managers, investors, and they say, yes, I want to do it, but tell me, where can I find these opportunities? And then there's this whole discussion about this green bubble. So I'd love to hear your thoughts, Katarzyna, as to what can governments do more.
Yeah, sure. I think you also mentioned just transition, Linda, and I think Martin made a number of really valid points. So, and this is, I think, really important within the context of CEE and investment. I mean, we cannot forget that delivering on climate and environment cannot be done if we forget about the social. And what this means, as we've always emphasized at the LSE, at GRI, it doesn't mean just doing climate and social as well. It means marrying those two in order to deliver projects that do not only deliver for environment, but also for the society. So in other words, we make the world a better place, but not only a better place in terms of cleaner air and better biodiversity, also a better place with better jobs, meaning that if the jobs can't only be green, they also have to be good quality jobs. We have to deliver on better sort of conditions for people to live in. So with that in mind, I think I think there is a lot of movement in the industry already, as we're seeing, especially in the case of some of the city investors like Royal London Asset Management. The climate aspect is already a sine qua non condition, so no one is even disputing that. Now, what we're really seeing is that people are sort of getting catching up with the idea that it also needs to deliver on the social. So what Erlam did was they worked with one of their biggest portfolio companies which was a utility to deliver a just transition strategy, meaning that they published something that was not only informing investors and the public on how they intend to deliver decarbonization, but also how they plan on taking the interests of their employees, of the local communities, of their clients into account. And this is something that will need to be done. Now, the one of the big challenges within that context is obviously finding a common understanding of what just transition really means, because even if you already agree to the fact that this is what you intend to deliver, you need to understand what this really means. And I think within that context, at some point, I think what will be required is for policymakers to help the industry understand that and find those common denominators, as has been done with the taxonomy. So I think to Jana's point, I do understand that wherever we're dealing with gold plating, wherever we're dealing with some compliance burden that may not necessarily be something that is absolutely required, then regulation may become a challenge. But within the ESG context or within the sustainable finance context, I think investors themselves, and indeed asset managers and other institutions, do really advocate for regulation, because it may mean lower costs for them, as they will be dealing with less diversity in terms of standards, in terms of reporting formats, etc. So there is a great role for governments to coordinate that effort, because this would mean that we can deliver it quicker, and time is important especially in this context.
Thank you, Katarzyna. Very interesting. But that actually brings me to ask Lubomír, I mean, what is your take on the EU taxonomy, right? And maybe Jana can follow afterwards, because Jana was part of our webinar with Martin Schulz from the Commission. And we're having actually another one at 12 p.m. today, again with Martin Schulz and Sandrine Dixon de Clèves and some other people from the actual Sustainable Finance platform to discuss what's happening next. And I would love to hear your thoughts, Lubomír. Are you welcoming the taxonomy? Because from the region, we have heard very different voices. There are people not very happy with the taxonomy, who see it as a big burden, and they don't really know how to deal with it or how it's going to be applied and what is it actually going to entail for them in practice. But we've also heard a few impact investors actually in the region who are quite excited by it, because they think that they're going to look quite good because of this. So what are your thoughts? What's your reaction to the taxonomy?
Yeah, well, thank you. I think it was interesting what was said both by all of you actually on this regulation and how you see it. I think that what was mentioned by Katarzyna on this harmonization and that regulators could indeed listen to the industry and then translate it into the governments actually then agreeing on the higher level in the European Parliament level there to harmonize it. I think it's what we as asset managers I think need to embrace and need to like, because that is that standard playing field that is very useful for efficient markets, especially for asset managers that are active or institutions that are active in more countries. It is very important that we do not diverge our costs to something that will be later on reworked or having multiple different interpretations on different country levels, because that's all bringing inefficiency. So the efficiency in the regulation, as Jana was mentioning, is important. To have a good regulation means having efficient regulation from the perspective of somebody that's managing assets for the clients who want us to be also efficient in delivering the results to them. Now, our organization has been active in sustainable finance for quite some time, as I've shown before 2000. So for us, a lot of the developments are not actually something that is that new to us as our core, because we believe we are active as a manager. We believe in sustainable objectives from our investments. So it is something that is really deeply in our understanding on and actually our part of searching the returns for the clients, in searching for the alpha. So for us, it is inherent. But I agree that there are some other players in the market that do have that are new to this, that do not have this concept, that do not have this optics of actually searching for the longer perspective in companies, also from the sustainable angle. And for them, it is maybe a little bit more difficult, and they are a bit struggling. Also, maybe having all those requirements that are actually mentioned in the recent regulation, it's quite a lot that the companies need to comply with, and unless they have been doing some work on this before, or they have been able to orient themselves in this field before, it is quite demanding on them. So there is no doubts about that. Also, in our part of Europe, a lot of companies are not having as great coverage as a lot of developed Europe countries or companies. So there's simply less data available. And the definitive, as you have mentioned, of sustainable statistics are some of the companies that actually are contributing to this effort, but these data are coming from other sources. And again, their understanding of interpretation of the data that they see from the companies can be different. We actually at RNIP, we actually do have our own models. Our analysts are actually covering the companies, and we take the data, raw data from the companies, and we do often use Sustainalytics or other sources for checking or for comparison levels. But we do believe in fundamental research and looking deep into the companies, collecting market data that is available, and then using the CFA would label it the mosaic theory of collating the information from the different parts of the markets, which do not need to be seen as something that is adding value to the evaluation model, but then in the combination they actually do. And collecting these pieces of information from the market sources is what we believe strongly in this, that contributes to market valuation and more efficiency in allocating our clients' funds. So that's what we do. And the taxonomy and regulation that has come on the market is actually making it, let's say, more transparent way on what we are doing and why we are doing that. So we actually like that. We embrace that because it fits into what we have believed on a long time, and we believe that the other market participants can utilize this as well. And it depends on whether they will develop their own internal sources of the data, or they will use other providers. But then, as in traditional investments, companies can use many other companies' reports, so side reports. They can rely on them, or they can actually do the research, the fundamental search, and add the value through that process. We believe that there is a scope for finding that value and adding the additional information in those sources, and do that extra work. That's the basis of what we do. On how the regulation could improve the field, or maybe make it more popular to the investment public, which I think is also quite a role maybe for the government and regulators to do, and to see how the public money is allocated. There are various public institutions or assets that are managed on the market. Requirements on how these assets are managed can be also a contributor, which is not small, on how the money is invested and how it contributes to the sustainability goals that the governments embrace, that the market embraces, and that the investing public actually wants to see as well. So I think this is another aspect on how this can help, and also popularizing the benefits of actually those sustainable impact strategies, or integration of ESG criteria in the investment concept in general, how it actually helps overall. I think that's a big task, and yeah, without education, but then we are talking about the education, financial education of general public, which we also find that it's not always at the level where we would like to see it. But this is a longer process, so hopefully in that process, this could be one of the elements that we could focus on.
Thank you, Lubomír. I mean, it's very interesting, the conversation also about ESG. So we have it a lot in the news, and it seems to mean a lot of things to a lot of people. I don't know how many of you recently saw the Scientific Beta's Honey, I Shrunk the ESG Alpha report, which was all over the news because, of course, this is a study that shows that ESG is actually doesn't provide a big alpha, actually, if you dig in deeper, right? And on the other hand, you have George Serafeim from Harvard University Publishing saying that no, actually, there is something in ESG, and that probably by now we are starting to have enough data and evidence that potentially those investments maybe are more resilient. So it's maybe not about alpha, it's about resilience. And I guess post-pandemic, it's all about resilience. We hear that word again and again. So, so Jana, actually sitting in Prague and seeing what's happening in the investment landscape, have you witnessed any more interest in ESG? Do you think that there's good understanding of what it is? Because from some of our conversations that we've had with different actors in the region, there's a lot of misconceptions and fear of it, or it's seen as this nice trend that you can brush up your credentials on, but actually nobody actually does ESG, right? It's just good PR, good marketing. So I would love to hear your insights. Have you seen growing interest in it? Do you think that local and regional actors will actually take it all more seriously going forward, or what do you think is going to happen next, especially in post-pandemic?
Linda, I can see that this approach is really changing, and that several years ago it was rather a burden than an opportunity for asset managers. Now I can see that there is growing interest both from companies who require some capital for their growth. There is growth of demand from the side of investors. So I think this is really changing, and actually we must go again back to the roots, and let's say, what is asset management? Asset management is when somebody gives you his money and asks you to manage it based on some ideas which are delivered in advance to the investments. You know, so it's not asset managers deciding on how shall they fully manage the money, because it's not their money. Asset managers are providing the service of managing money of investors. If there is lack of investors and not enough of investment opportunities, then you have a problem. So this is whole ecosystem. It will never work if somebody comes and says, you must invest the money of the investors this way, because actually you can't, because investors would not give you their money if it would not be invested in the way they wish for. But what is brought by the whole sustainability file, this is that there is a growing interest of investors for the money to be invested in the sustainable way. And this is where taxonomy comes into play, because taxonomy is the key, is the crucial piece of legislation which actually should have been the first one to be adopted on European level. You cannot act sustainably without actually knowing what does it sustainable mean. And there was a bunch of rules adopted, such as SFDR, which aimed at bringing more transparency. However, with the lack of quality of the regulatory technical standards, or these regulatory technical standards being published quite late, which is not helping asset managers to promote the sustainable file in the most effective way. Therefore, this is whole ecosystem, but I think in the region, this is really changing. There is a growing demand. There is a growing interest of the whole of all the participants in the asset management or in the financial industry, but the regulation is still the key, and taxonomy is on the top of the regulation, which needs to be adopted, and which needs to bring some or more clarity to the sustainable file.
Thank you. Yes, I mean, I couldn't agree with you more in the sense that we need more clarity, and we do really need to figure out what data actually is meaningful, because currently we just have an overload of data. So when we were working on this big project, it was extremely interesting also to see what sits under each of these data points. And unsurprisingly, often it is just statements that don't necessarily relate to the impact or whatever is happening on the ground. So that is a bit disappointing. We have somebody that's actually put a comment. Jiří Jaravek has put a comment that the whole EU sustainable package from April seems very complex and complicated. Of course it is complicated. It took such a long time to even create it. But, and I also couldn't agree more with the fact that it is the role of think tanks and different bodies trying to explain and simplify it, because it is our kind of purpose as well as a center to try and, in layman's terms, explain why it matters, what is it. However, when it comes to actually applying it and implementing it, well, this is another interesting discussion. Should it actually be non-governmental organizations helping to do this, or should it be somebody else? Because regulation is regulation, and sadly, that's going to be mandatory going forward. So we can help with information, we can help with dissemination of information and explanations, but I guess active assistance in figuring out how to implement it, well, that's probably not the role of think tanks. But I would love to hear your thoughts, Martin. Do you think that we should be doing a better job to explain? Because we have been trying to, but again, the interest is very ad hoc. So usually the biggest questions we get is, how do I actually, how do I do the taxonomy or ESG without actually having to pay for it? Or how do I do it that I comply with it in principle, but I don't actually change anything in my operations? So, and that is the crux of the problem, right? We actually need to rethink the KPIs, the key performance indicators. We need to set some sort of benchmarks and targets so that we can get somewhere. And that's something that I think people are quite reluctant to do at the moment.
I think there is going to be an increasing pressure from not just policymakers, but from all sides of also the financial community, to start looking at down to even like what's the fiduciary duty of the company leaderships, because it's starting to move away from purely what's the value on the stock market, or what are the returns to a kind of the old Anglo-Saxon model of the corporation to more back to more what historically has been the German model of corporation, with the corporation serving wider societal function. And you can look at it also from the purely Anglo-Saxon way of finally starting to incorporate a bit more some of the external costs that the companies have been offloading on the society, be the environmental cost or social costs, back in a way into the balance sheet. Now, yes, the trick is how to do it simple, and this is where we haven't found the answer yet, because clearly it would be challenging to kind of build on the answer of more and more bureaucracy, certificates, audits, and God knows what. Maybe not for the industries that are doing these audits. I think that would be definitely a welcome thing, but ultimately we cannot spend more time on these things and actually delivering the work that we need to do. And reporting of the greenhouse gas emissions doesn't equal thinking them. You just kind of say how much you release. Now, in terms of the information, there is always need to inform more and better, but it's almost kind of cliche, because when you go out on the streets, people don't necessarily care or should care about this. Honestly, this is something where they expect the system to work for them. And for me, the question is more, okay, how to bring on board the concerned sectors. And it's not only, it was very interesting, it's not only the financial sector or business sector, but or the state, but it's also the municipalities, and look for ways on how, without compromising the integrity, make it more feasible and kind of more streamlined for the businesses to look for the sustainable financing, for the, kind of having basic criteria that are understandable, and kind of trying to translate the details of the regulations into basic principles that could be understood much easier, and then build it from there. And looking for more targeted effort also in terms of education, and do some general brochures into having a proper structured dialogue with the stakeholders, like this conference. I think this is something which is definitely needed, and broadening it up to, as I said, also the businesses and municipalities and regional governments.
Thank you. I mean, I agree. The other thing that I think needs to change in the region is, well, if you want the information, get in touch and ask for it. We have been very proactively trying to get in touch and disseminate information and give free materials, because actually the other thing is there's so much free resources. So if you want help is usually available. It's actually about asking for it. We recently completed 2 separate workshops on green bonds training on issuance for cities and municipalities, and it was actually quite encouraging to see that enough cities signed up. So there is that interest, and we just hope that that's going to keep growing, because we need those green projects so that there is actually the opportunity to invest in them. And it can be good PR, right? I mean, realistically, who doesn't want cleaner air or, better health outcomes as well? So it's not about just the planet, it's about people as well. But thank you so much, everyone. I think we've just gone over time by a couple of minutes. But thank you everyone for joining. It's been absolutely fantastic and a great conversation with very interesting perspectives. I think we've managed to cover a lot of ground in an hour and a half. But thank you again for joining, and hopefully we'll see you at some of the other events that we've scheduled for the rest of the week.
Thank you.
Everyone.
Bye-bye.
Thank you very much.
Bye.
Bye-bye. Thank you.
Bye.